Welcome to the NeuroBiz podcast channel. Today, we're unpacking a topic that confuses almost every new investor at some point: stocks, shares, and ETFs. They sound similar, people use them interchangeably, and honestly, that's where most beginners go wrong.
Exactly. And what's interesting is why this confusion doesn't just lead to misunderstandings. It often leads to bad investment decisions. So today, we're going to simplify everything. No jargon, no hype, just clarity.
Let's start with the most basic question. Are stocks and shares different things? Short answer, Quest, not really.
Right. A stock is simply ownership in a company.
Okay.
When you hear someone say, I invest in stocks, they're usually talking in a general sense, right?
And a share is just a unit of that ownership.
Yeah.
So if a company is cut into a million pieces, and each piece is a share.
Right.
If you own 10 shares, you own 10 tiny slices of that business.
This distinction shows up more in language than in practice. In the US, people say stocks.
Yeah.
In the UK,
Many other markets, people say shares.
But economically,
Same concept now, ownership.
so mistake number one beginners make is thinking stocks and shares are totally different asset classes. They're not.
Yeah.
It's mostly terminology.
Yeah.
Now let's talk about ETFs, because this is where beginners either level up or get intimidated for no reason.
ETF stands for Exchange Traded Fund. And the easiest way to think about it is this. An ETF is a container that holds many stocks inside it. Instead of buying shares of just one company, an ETF lets you buy a small piece of many companies in a single transaction. For example, one ETF might hold the top 500 companies in the US. So with one purchase, you're exposed to tech, healthcare, finance, consumer brands, all at once.
This idea aligns strongly with principles from classic investing literature like The Intelligent Investor by Benjamin Graham.
Graham emphasized risk reduction through diversification, not speculation.
Yeah.
And ETFs do exactly that, Heino, automatically.
There's a reason ETFs dominate beginner portfolios and, honestly, many professional portfolios too.
First, diversification. If one company struggles, it doesn't destroy your entire investment. And second, simplicity. You don't need to analyze dozens of balance sheets or predict which company will outperform next quarter. Third, Tim, cost efficiency. Most broad market ETFs have very low fees compared to actively managed funds. And fourth, behavioral protection. ETFs discourage overtrading, which is one of the biggest reasons beginners lose money.
This aligns with modern beginner investing guides as well. For the core message is consistent. Start broad, stay diversified,
Go.
think long term.
That all you said.
Let's talk about the big mistakes.
Mistake number one, blame. Thinking ETFs are too advanced. Ironically, they're often safer than picking individual stocks. Mistake number two, class. Overconfidence. Beginners often believe they need to beat the market immediately.
Benjamin Graham warned against this mindset decades ago. He argued that investing is not about outsmarting others.
It's about discipline and patience.
Very true.
Mistake number three, emotional investing. Buying because something is trending, selling because the market dips.
That's where most portfolios quietly fail, not because of bad assets, but bad behavior.
So here's what beginners should remember. Stocks and shares represent ownership. Don't overthink the wording. ETFs are not complicated. They're simplified diversification tools. And successful investing isn't about excitement.
It's about consistency, patience, and risk management.
If you're just starting out, focusing on broad ETFs and learning fundamentals is often a smarter move than chasing individual stock wins.
That wraps up today's episode of the NeuroBiz podcast channel.
If this episode helped clear things up, share it with someone who's just starting their investing journey.
Thanks for listening, and we'll see you in the next episode.